Back, everyone. Next, we have Vox Royalty Corp. It trades on the NASDAQ under the symbol VOXR and on the TSX under the symbol VOXR. It's a returns-focused mining royalty company with a portfolio of over 60 royalties spanning 6 jurisdictions. Please welcome its Chief Investment Officer, Spencer Cole. Welcome to the conference today, Spencer.
Thanks, Anna. It's a pleasure to be here today.
All right, the floor is yours. Call me back when you're ready for questions.
Fantastic, will do. Well, thanks for everyone's time today. As Anna mentioned, my name is Spencer Cole. I hope you can understand my rather thick Australian accent. I'm an Australian mining engineer by background, and I'm the Chief Investment Officer of Vox Royalty. You're catching Vox at a really exciting time. Commodity prices, in many respects, are at all-time highs. Gold's certainly at a record level, and generalist investors are looking for ways to get exposure to commodities and metals, but doing it in a way that exposes them to less risk. So I'm excited to walk through the Vox Royalty business model that we've refined over the last 10 years, and we think presents generalist investors the best way to get leverage exposure to metals with much less of the downside that a lot of mining companies present. I will be making some forward-looking statements, so I refer listeners to the disclaimer on the Vox Royalty website. So Vox, in a nutshell, is a conduit for generalist investors created by generalist investors 10 years ago with only $7 million of seed capital, with the purpose of creating leveraged exposure to metals with asymmetric upside and limiting the downside common to most mining companies. Because unfortunately, mining equities have historically underperformed major equity indices such as the S&P 500 over the past 20 years. This is because of a lot of the downsides and risks inherent in the mining industry in the form of esoteric engineering risks, serial equity dilution, and often, unfortunately, misaligned management execution. Vox was created to solve those issues, particularly for generalist investors. Over the past 10 years, we've come up with a systematic edge and ability to identify forgotten mining royalty contracts that cover tomorrow's or the next mining assets that are just about to be built. And in the last couple of years, we've been successful in delivering the highest return on invested capital in our entire industry. And then importantly, we are entirely a shareholder-aligned management team. Management owns 10% of the company ourselves, and our families own stock on top of that. So what do we do in a nutshell? We are a mining royalty investment vehicle. So that means we find royalty contracts, so contracts that typically entitle someone to a percentage of revenue from a mine, and we acquire those legacy contracts at a significant discount to what their fundamental value is. And we focus on mining royalties that cover properties that are just on the cusp of a major event. So typically just on the cusp of construction or production. That's typically where we find the deepest value. And so our sweet spot is buying these mining royalty contracts that were created 20 to 40 years ago. And they're basically on properties that we expect to be in production and cash flowing within 12 months to 36 months typically. Our focus really is on compounding per share returns. And in the last 2 years, we've been successful in delivering 130% cash flow per share growth in 2 consecutive years. That really is the focus for us, is delivering and compounding those types of returns for our investors. I mentioned that over 10 years, we've developed a really, a strong competitive edge. That takes the form of the world's largest proprietary database of mining royalty contracts. So over the past 10 years, we've built a intellectual property edge, a database of over 9,000 unique mining royalty contracts. And we use that database to find forgotten royalty contracts that we can buy at significantly discounted prices, often at sort of 10% to 40% of what their fundamental value is. And we focus on royalty properties and mining properties that have royalties on them in very safe countries. So 90% of our portfolio is weighted towards Australia, United States, and Canada. In terms of the mines that we focus on acquiring royalties over, we love simple mines that any mining company can make money on. So we focus on shallow open pit mines, not deep underground, stable, safe countries, as I mentioned before, and generally simple processing methods like common gold processing methods that have been done the same way for 100 years. So if we can remove the common technical mining risk that often impacts the returns of a lot of mining companies, that means the risk-adjusted returns for our investors are significantly more attractive. And all of this is enabled by us being a team of in-house technical mining experts. We're a team of mining engineers and geologists serving a group of generalist investors who themselves aren't mining engineers or geologists. And so we do the hard work of picking the mines of tomorrow that are about to be built so that our generalist investors don't need to do that work. A little bit about our cap structure and our royalty portfolio. So we're a $150 million US company, dual listed on the NASDAQ and the Toronto Stock Exchange. We have no debt, net cash position. We do have a credit facility that's fully undrawn of US $25 million with Bank of Montreal. Management and board hold over 20% of the company. So we are truly sort of equity aligned and we're focused on a win for all of us investors. In recent months, we've had some of the who's who of global mining funds buying into the stock. So groups like BlackRock's World Mining Trust out of London in the last few months have taken a position. Groups like US Global out of San Antonio, some of the largest mining funds out of Europe, such as Gold 2000, Conwave, they also have a meaningful position in the company. And then we have a growing base of family offices and generalist funds who have been buying, particularly through the NASDAQ in the last 12 months, who this compounding returns model resonates very strongly with. A little bit about our royalty portfolio. We're 70% precious metals and more specifically gold weighted. The other 30% is across a basket of about 10 other metals, from copper to iron ore, and even a little bit of diamonds as well. I mentioned we have very low geopolitical risk. Approximately 90% of our portfolio is Australia, Canada, and the US. I'll touch more on why Australia in a later slide. And then we have a portfolio of 70 royalties, 70, of which 7 of them are producing today. And then as that projects out over the coming years, we expect that to grow up to north of 20 producing royalty properties. So the macro environment we find ourselves in is extremely advantageous for the gold price, as most of you would be aware. US national debt is approaching 36 trillion. This chart is a little bit busy, but it basically just shows, if you look at the gold price in gold, with reference to both the US federal deficits in recent years and then also the growing total public debt as a percentage of GDP. Obviously, the situation in the macro environment in the United States with growing national debt and, unfortunately growing deficits is extremely supportive of a rising gold price, which is one of the many reasons why we find ourselves in a record high gold price environment today, which is extremely supportive for VOX being 70+% weighted to gold. A little bit about what's going on in our portfolio. Of our 70 royalties, over 50 of them are in Australia. And more specifically, the bulk of those are in Western Australia. And what we're seeing in Western Australia is gold, when you convert it into Australian dollars, has been at record levels really for the last 4 years. It's now over $4,000 Aussie dollars an ounce. And what that means for our investors is a lot of our royalty properties, our gold royalty properties in Western Australia, are being rapidly advanced into production to capture this record high gold price environment. Just today, we put out a press release on 3 of our development stage royalty properties in Western Australia that are rapidly being advanced. So on the left, this Bulong gold royalty that literally just started first production last month. So that's got sort of immediate, near-term revenue implications for us. Castle Hill is another construction stage gold royalty in Western Australia that's being rapidly advanced into production over the coming months and quarters. And then Plutonic East is a past-producing high-grade underground gold mine in Western Australia that's rapidly being advanced into first production in the first half of next year. So what's the significance of this? This just means more gold production being rapidly brought forward where we hold a percentage royalty on these properties. And so it just means royalty revenue to the benefit of our investors is being rapidly accelerated in this record gold price environment. Look, for generalist investors, it's really challenging to try and pick which exploration projects or which development stage projects within the mining industry are going to be the winners, so to speak. On average, it takes about 16 years from first discovery to production in mining. The royalty that started producing for us last month, the Bulong royalty, to put that in perspective, that was 6 years, only 6 years from first discovery into first gold production. So that's an example of where our management team is picking projects that are rapidly being accelerated beyond what is normal in our industry from discovery into production. So we only bought that royalty approximately 3 years ago, and now it's in production. So for generalist investors who don't have the toolkit, aren't mining engineers or geologists, and so for them who are trying to pick, needle in a haystack of which mining explorers or developers are going to sort of be accelerated into production and free cash flow, those generalist investors don't need to do that work, because that's essentially what our management team is focused on doing, over the past 10 years. Likewise, for investors that are looking for exposure to mining producers, within the industry, there has been quite significant cost inflation. This is just one example of Newmont Corporation, the world's largest gold producer. In the last 2 years, they've seen their operating costs grow by approximately 20%. And so, with their recent quarterly, investors have sort of taken a pretty strong view on, with that rampant cost inflation. And so likewise, not only is it difficult for investors to pick the right explorer or developer within the mining industry, but also within the producer category, this cost inflation really eats away at the incremental margins created by record high gold price. In stark contrast to a royalty company such as Vox, where our entire company, as a $150 million US market capitalization company, we're only a team of 6 people. That headcount hasn't grown. So the cost inflation, we're not exposed to this cost inflation that the mining producers are, but we still get the benefit of the rising gold price through our percentage revenue royalty contracts. So for investors that don't want to be exposed to this type of cost inflation, but still want the metal price upside, still want the benefit of discoveries and production expansion, a royalty model such as Vox offers that sort of asymmetric upside without some of this sort of cost inflation downside. And look, it's interesting to note that when you look at Australian gold producers versus Canadian gold producers, Australian gold producers are trading at about a 30% premium on a relative price to value basis relative to their Canadian peers. Now, that's in stark contrast to Vox as a company, where despite having the majority of our royalties in Australia, we continue to trade at a discount to our North American peers. And so, that's part of the opportunity within Vox as it currently stands. Is I think a lot of North American investors don't fully understand the dynamics that are going on in places like Western Australia, and how supportive Western Australia is as an operating jurisdiction for gold exploration, development, and production. So 2 snapshots and lenses on our portfolio. I mentioned before, we are heavily weighted towards Australia, and more specifically Western Australia. So over 90% of our revenue last year came from Australia. If you look at Western Australia compared to a lot of North American mining jurisdictions, even like Nevada and Arizona. In Western Australia, it's not it's common to go from discovery into production within 4 to 8 years. And when you compare that with North American mining jurisdictions, you're typically seeing sort of 10 to 20 years, in some cases north of 20 years to go from discovery into production. And because we as Vox, we focus on buying royalty contracts before they've come into production, typically when they're just about to go into construction, what we want is very pro-mining jurisdictions, such as Western Australia, where the probability is maximized that this royalty property goes from development stage into production rapidly, so that we can get payback extremely quickly. So we're heavily weighted towards Australia. Likewise, we're heavily weighted towards large cap mining operators. So approximately 2/3 of our royalties are operated by mining companies, large mining companies that are greater than $2.5 billion in market cap. So what does that mean? We as a royalty holder, we're not on the hook for capital costs or operating costs. So what we need is well-capitalized operators who are going to invest hundreds of millions of dollars in our royalty properties to bring these properties into production and then expand them once they're in production. And so we're a bit of an anomaly as a small cap royalty company having such a heavy weighting to large cap operators. So I touched on this a little bit earlier. This is sort of a bit of a catalyst slide, I guess you could say. Over the next 18 months, we have 5 separate royalty properties that are in varying stages of construction and development. So, we expect, and the 5 brokers that cover the stock expect, we'll have an extra 5 incremental producing properties that are expected to come into production over the next 18 months. So that means incremental royalty revenue from these new mines that are being built. And based on the operator guidance, we expect as we enter into 2026, our producing royalty count will go from 7 to north of 10 producing royalty properties. A little bit about our returns. I mentioned from the outset, we are a returns and driven company, and we're focused on compounding per share returns. So we've invested $55 million into this portfolio of 70 royalties. We've already been paid back, over $32 million of that. And you'll see on the left-hand side of this slide, in many cases, we've been paid back a multiple of invested capital, from 2 times to up to 14 times our original investment on these royalty properties, most of which that are still producing today. And so, the ultimate multiple on invested capital that we expect to generate, it's obviously quite substantial. We expect over the next sort of 2 years that we have strong potential to be fully paid back on the full $55 million that we've invested in our portfolio of royalties, which is in stark contrast to the rest of the industry. These 4 large cap operators are 4 of our key operating partners. And you see on the left-hand column, they range from sort of $9 billion companies up to $60 billion companies. I won't go through this in full detail. The key message here is we're picking royalties on mining properties that are very low risk, extremely large operators in Australia with open pit mines that have very low technical mining risk, that have a lot of near-term catalysts in terms of first production expansion and whatnot, that is all to the benefit of our investors. This chart shows a little bit about our revenue or royalty receipt growth. So we've tripled revenue in the past 3 years, but we still remain very optimistic about what the future holds. So I mentioned that we have a number of properties in construction. So if we did no further royalty acquisitions, over the next 3 to 5 years, we think we have potential that there could be, up to and hopefully exceeding 20 separate producing properties within our royalty portfolio. We are a dividend paying company, which is a bit of an anomaly as a $150 million company. So we're currently paying about 1.6% dividend yield, which is actually the highest within the royalty industry. But candidly, most investors tell us, that they're buying into the stock as a growth at reasonable price or GARP type model, not necessarily for the dividend. But the dividend is important for us, particularly for our long-term investors who've been very supportive, in some cases for up to 10 years. That dividend is quite meaningful for them and their families. I mentioned we tripled revenue over the past 3 years with significant amount of embedded growth to come. Despite all this that I've shared with you, we still trade at a discount to broker price targets. And part of that disconnect in the stock we as management view is linked to a misunderstanding of our Australian royalty properties. We focus on returns, and that's certainly been the track record. Last year, we exceeded all of our peers by sort of a multiple in terms of, this is a bit of a crude metric on return on capital. Just looking at last year's revenue as a percentage of capital invested, we're generating north of 20% returns. And most brokers expect that to grow considerably as new properties come into production. We continue to trade at a discount to our peers on a revenue basis and a price to value basis. So this is part of the inherent opportunity in where the stock is trading today. And then I won't touch on every dot point here, but last year was an extremely productive year for the company. Record revenue, material increase in cash flow per share. We increased our dividend for the second year running, and we brought on a lot of incremental research coverage. So we now have 5 separate brokers covering the stock. But what I would say is 2024 and as we project into next year is looking even more optimistic from management's perspective. So we locked in the credit facility in the first quarter of this year. We increased the dividend again, and we've had a number of key, particularly gold properties, that have had discoveries and resource expansions and material construction developments that I guess contribute to near-term revenue expectations and potential near-term revenue growth expectations. So with that, I will take a breath. Thanks for your time, and I'll open the floor up to any questions anyone has.
Wonderful. Thank you. Yes, take a breath. That is a lot. But let's talk a little bit about, but it's important stuff that you guys are doing and your focus on gold royalties in Western Australia. Why do you focus so much in that area? What makes that mining jurisdiction so attractive?
Yeah, it's a great question. Thanks, Anna. So look, as I mentioned, the timeline from discovery into production is very rapid in Western Australia. It's the quickest in the world based on our benchmarking. And so I guess the ease of doing business from a mining perspective in Western Australia is second to none. There's the most labor, the most abundant capital that's chasing gold production, and the permitting and environmental sort of landscape is extremely supportive for people that are looking to develop and expand gold mines. So that's the crux of why we tend to focus on Western Australia, and pound for pound we find less competition to acquire royalties in Western Australia, which is, I guess, the icing on the top.
And so how much leverage does Vox have to the rising gold price?
Yeah, so it's not as straightforward as investors might think. If we get 1% of the revenue from a mine, yes, we get 1% of a rising gold price. But I'd say the more substantial leverage that Vox has and Vox investors have to the gold price is, as the gold price goes higher, typically mines are brought forward. And so what we see is volume and production being brought forward, in some cases by a matter of years. And so revenue is being accelerated forward. So it's not only getting, a gold price that's risen 30% in the past year, it's also getting, ounces and production that's maybe in some cases 1, 2, or 3 years earlier. So that revenue is being accelerated. So it's sort of a multiple factor that's almost like a flywheel that we see in sort of revenue organically growing in a rising gold price environment.
And has there been much institutional buying in Vox in recent months?
Yeah, absolutely. I think one thing that held investors back sort of 2 years ago was liquidity. 2 years ago, we only traded about $100,000 a day in the stock. Now, post the NASDAQ listing, which happened 2 years ago and has really picked up steam in the past 12 months. We've seen that liquidity go from $100,000 a day to closer to $600,000 to $700,000 a day US. So a 7x increase in liquidity. And with that, we've seen a number of large institutions start to buy into the stock, such as BlackRock's Global Mining Fund, in the last few months.
And Nate says the stock is performing well and pretty much at an all-time high. Congrats. So do you see much more room for an increase in valuation?
Look, I think when you look at how brokers value the company, they still certainly see quite a bit of headroom in terms of their price targets relative to where we're trading. What I would also add is that most of the 5 brokers that cover our stock, they only value our top 10 to 20 royalties, which, with a portfolio of 70 royalties, we think there's a lot of value that frankly just isn't even being included to get to those target prices above where we're trading. So, management remains very optimistic and confident around what the future holds. I can't speak to, what I think we should be trading at, but what I can say is, I think against all objective metrics, we continue to trade at a pretty key discount, both relative to peers and relative to fundamental analysis.
And Mike says, when you take a new royalty deal for a non-producer, is your contribution enough to get them through development and into production, or do you have to continuously increase your position or investment? How does that work?
Yeah, it's a great question from Mike. So we do not fund mining companies. What we do is we go and buy an old royalty contract that was given to, a rancher or someone who held the mineral rights 20, 30, 40 years ago. So we're buying a legacy contract on that royalty, on that mining property. So we do not give capital to the mining company. So after we bought that royalty contract, that's our one and only check. So we don't have to contribute any money to actually build the mine. That's the liability or the investment for the mining company.
And last question from Cameron. In existing producing and turning to producing companies, how do you monitor the site and the production? What does your control look like?
Yeah, so the overwhelming majority of our royalty operators are publicly traded companies. Most 2/3 of them large cap operators. So there is a lot of public disclosure on what they're mining at our royalty properties just from public filings. In addition to that, we get quarterly royalty statements. So we get an extra level of granularity in our quarterly royalty statements. And then we also have periodic calls with the mining companies themselves to sort of monitor how the properties are being mined and developed. In addition to that, we do use satellite imagery, drone footage to sort of verify, I guess, the mining activity that we're being sort of reported to. And so, we'll triangulate a lot of different data points to verify, what's actually being mined. And if it is required, we do have audit rights, so we can selectively audit some of our mining operators if required.
Well, wonderful. Spencer, do you have any closing remarks for our viewers today?
No, look, I just thank everyone for their time. And as I said from the outset, you're hearing about Vox at a really exciting point, both from a macro perspective and in the company's 10-year history. Vox was created 10 years ago for a market such as what we find ourselves in today. And, the amount of embedded growth and catalysts we have coming up, I think it's a really attractive time to be looking closer at Vox Royalty.
It's all in the timing. All right. Thank you so much for being on our conference today. Please come back with some more updates in the near future.
Fantastic. Thanks for your time, Anna.
All right, everyone. We'll be right back with our next presenter.